Inflation? That hidden force you hear about in the news every day. Feel in the price of almost everything in your daily life, even standing in front of supermarket shelves. Yet whose true face no one fully explains to you. Prices keep rising. Every month you can buy less with the same amount of money. Your purchasing power erodes day by day. But no one honestly tells you this. This is not just a natural process. So what, or who, is really behind inflation? Coincidence, fate, or deliberate decisions? In this video, we are opening the story that is never told to you. Most people think of inflation as simply prices going up. But throughout history, inflation has always been the result of decisions made by those in power. Governments, major corporations, and the financial system. When governments want to spend more, when their budgets fall short, when they look for an invisible way to reduce their debts, money printing enters the picture. Every newly printed bill quietly steals a tiny piece of the value of the money in your pocket. No one asks for your signature. No one asks if you agree, but the outcome is certain. With the same salary, you buy fewer goods. That is why inflation hides a truth even economists often avoid saying openly. It is an invisible tax, but governments are not alone in this story. Big corporations are part of the game as well. When costs begin to rise, companies raise prices by saying, "There is inflation," sometimes because they truly have to, and sometimes because they use this environment to secretly inflate their profit margins. When you look at the price tag in the store, you simply say prices went up, yet behind the scenes, there are strategic decisions made under the cover of inflation. Supply chains, energy prices, exchange rate volatility, global crises, all of these are excuses, but at the core there's always a choice: who will pay? And most of the time, the bill is sent to the public. Inflation is, in reality, a struggle. Who will protect the real value of money? Who will lose and who will win? That is why inflation is not just a chart, a percentage, or a news headline. It is the silent story of millions of people losing control over their lives. In the first part of this video, I want to show you this. Inflation is not a wild beast that no one can control, as you might think. On the contrary, it emerges from very clear decisions, very concrete interests, and very deliberate steps. Now slow down, take a deep breath, and ask yourself this question. If inflation is not a naturally occurring process within the economy, then who does it benefit? That is the real question. In the next step, we will chase the answer together. As we descend deeper into inflation, the first truth we encounter is this. This system does not exist on its own. There is an invisible hand that guides and manages it. However, it would not be accurate to say that this hand belongs to a single person or a single institution. Governments, central banks, major corporations, and global market players, all of them are essential parts of this game. But the truly critical point is this: not everyone is playing the same game. Starting in the early 20th century, governments discovered a new tool to grow their economies: expanding the money supply. This gives a country's treasury an invisible power, but at the same time places an invisible cost on the public. As governments borrow more and increase the amount of money they print, the real value of money quietly erodes. You do not notice it. Your salary stays the same, but your purchasing power falls. This is one of the sharpest faces of inflation. Value loss happens without being clearly felt. Yet in this story, corporations play a role just as decisive as governments. When costs rise during a supply crisis, companies respond first by passing those increases on to prices. But here there is a fine line. Some companies raise prices only as much as their real costs increase, while others turn this environment into an opportunity. By using the excuse of "there is inflation," companies that raise prices far beyond what is necessary grow their profits. Along with rising inflation, This behavior even has a name in economic literature: profit-driven inflation. In other words, part of price increases is not about costs at all, but about strategic corporate choices. So what is the role of the public in this system? This is where the most painful truth emerges. The public is both the carrier and the victim of inflation. As inflation rises, purchasing power falls, savings melt away, and living standards deteriorate. Yet at the same time, when the economy struggles, public spending keeps the system alive. In short, the system makes the public both the loser and the one carrying the burden. The primary mission of central banks is to balance this trajectory. They raise interest rates, lower them, inject money into the market, and control the flow of credit. But every one of these decisions has a cost. When interest rates rise, low-income borrowers suffer. When interest rates fall, inflation accelerates further. In other words, no decision in this system is good for everyone. Every choice affects a different group. What I want you to understand in this section is this: it is not correct to look for a single culprit behind inflation, because this is a multi-actor, multi-layered power game. However, no matter how broad the system of inflation may appear, all actors share one common goal: protecting their own interests. In the next section, we will explain how this conflict of interests leads to economic crises, creates bubbles, and causes collapses. Because inflation is not just a problem of today, but one of the oldest economic struggles in human history. One of the most critical factors behind the rise of inflation is expectations. In economics, this is called the expectation spiral, and once it begins, it can become almost impossible to stop. Even if markets have not yet been affected by any actual cost increases, people's fears that prices will rise cause everyone to change their behavior. Supermarkets update price tags early. Shopkeepers raise prices, consumers start stockpiling, and companies build future price increases into their contracts in advance. As a result, even before real inflation materializes, inflation emerges behaviorally. This is exactly what economists fear the most: inflation generating itself. At this point, the balance between supply and demand becomes distorted. Demand is pulled forward out of fear that things will be more expensive in the future, while supply shrinks due to cost uncertainty. The result? Emptying shelves, rising prices, and accelerating inflation. But this process creates a major fracture not only in the economy, but also in the psychology of society. Because what people lose most is not money, but trust. When trust disappears, the foundation of the economy collapses. Money is, after all, nothing more than paper or numbers on a screen. What gives it value is society's shared belief. When that belief is damaged, no economic tool can provide stability. History offers countless examples of this. During the Weimar period in Germany, people could not buy milk just a few hours after receiving their wages, because prices were changing by the hour. In many Latin American countries, people spent all their money the same day instead of saving it, because morning prices were no longer valid by the evening. When expectations spiral out of control, even the strongest economies can collapse. Today, managing expectations has become far more difficult. Social media, non-stop news cycles, and global information flows can spread panic within seconds. A crisis in one country can spill over into another based on nothing more than rumors. For this reason, inflation has become not only an economic problem, but a global psychological phenomenon. People's fears about the future shape the spending and investment decisions they make today. And when those fears are not properly managed, economic balances can deteriorate extremely quickly. In the next section, we will examine another invisible force that fuels inflation: the role of global markets and major financial players. Because sometimes inflation is understood as a national problem, but the ones pulling the strings may not always be within the same borders, and may be much farther away. Behind the scenes of inflation, There is often a force that remains unseen, but is felt like a massive wave. Global capital flows. The modern world economy is so deeply integrated that an interest rate decision made in one country can even affect food prices in another. This is because capital has become a borderless phenomenon, an invisible force that moves instantly and can flow to wherever profits appear within seconds. At this point, if global investors perceive a country as risky, they exit that country's currency and redirect their capital towards safe havens. This flight causes the local currency to lose value rapidly. As a natural consequence of currency depreciation, imported goods become more expensive, costs rise, and inflation begins to climb. In another sense, global capital functions like a force that widens existing economic cracks within countries. When investor confidence is shaken, currencies begin to erode quickly, no matter how strong a country may appear. This is exactly what happened during the 1997 Asian financial crisis. A speculative attack that began in Thailand quickly spread to Malaysia, Indonesia, and South Korea. Millions of people lost their jobs. A single financial shock turned an entire continent upside down. Because when capital panics, it recognizes no borders, culture, or geography. However, there is an even deeper side to the problem. Major financial players and speculators, they do not merely observe markets. At times, they can steer them. Large London-based funds, Wall Street banks, and massive investment firms with trillions of dollars at their disposal can influence a country's currency, interest rates, and even its economic future. One of the most well-known examples is George Soros's attack on the British pound in 1992. Through the transactions they carried out in a single day, they made it impossible for the United Kingdom to defend its currency, forcing it to exit the European exchange rate mechanism. Soros famously said that day, "I beat the Bank of England." As major financial actors gain power, smaller economies become increasingly vulnerable. These actors affect not only their own countries, but markets across the globe. At times, inflation does not stem from a country's internal mistakes, but from massive external shocks. A surge in global oil prices, an energy crisis triggered by war, or a break in the supply chain. Any of these can spread inflation across the world like a contagion. Therefore, it is not correct to think of inflation solely as the result of poor domestic decisions. Inflation is also a phenomenon born from the complexity of the global system. In the next section, we will explain how governments and central banks develop strategies in the face of this immense power, whether inflation can truly be fought, and which policies make that possible. Because while some countries drown in these waves of inflation, others somehow manage to remain standing. The answer must lie in the decisions they make. The battle between market reactions and the decisions made by governments emerges as another hidden force behind inflation. Every economy is built on a foundation of trust. And when that trust is shaken, prices can spiral out of control almost instantly. Especially from the mid-20th century onward, governments began experimenting with different policies to fight inflation. Yet every decision carried unintended consequences. For example, when state budgets ran deficits, governments often turned to printing money. But every additional unit of money printed did nothing but push prices higher, as long as the quantity of goods and services in the market remained unchanged. When supply stays the same, demand is artificially inflated, making inflation inevitable. What appears to be a simple relationship turned into a cycle that pushed countries from one crisis to another. While politicians pursued short-term solutions, inflation became a long-term problem. One of the most striking examples occurred in Latin America during the 1980s as money printing spiraled out of control. Prices in countries like Argentina, Brazil, and Bolivia began to change weekly, sometimes even daily. People rushed to the supermarket the moment they received their wages, knowing that a day later their money would be worth half as much. This period became known as the age of hyperinflation, and it upended the lives of millions. However, inflation is not triggered solely by money printing. Political uncertainty, sudden changes in government, wars, scandals, and a breakdown of trust can also drive prices sharply higher. When trust between the state and its citizens erodes, the currency loses value as well. That is why some countries developed a new strategy in the fight against inflation: independent central banks. Operating independently from governments, these institutions began managing monetary policy based on data and analysis rather than political pressure. Interest rate decisions were shaped by economic evidence, not political demands. In many countries, this system succeeded in bringing inflation down. Yet, no matter how independent a central bank may be, it cannot fully safeguard trust on its own, because the pulse of the economy now beats not only within national borders, but across global markets. In the digital age, a single central bank decision is processed by millions of investors within seconds, and algorithms instantly translate those decisions into prices. This rapid reaction has become both the greatest advantage and the most difficult obstacle in the fight against inflation. In the next section, we will look at the future of inflation and how prices may be shaped in a new financial era driven by artificial intelligence and algorithms. Because the fate of inflation may no longer be decided by people, but by a few lines of code. Inflation today has a far more complex structure than it did in the past. The game has grown larger and new players have entered the field. It is no longer just government decisions or market fluctuations. Global supply chains, energy prices, geopolitical risks, and even social media rumors can now have a significant impact on price movements. In the New World Order, inflation has become a shared fate of the entire world, not just a single country, because money no longer circulates only in our wallets. It moves through digital systems, global algorithms, and borderless capital flows. A crisis that erupts in one country can affect prices on another continent within seconds. This rapid spread is what makes inflation one of the most invisible yet most powerful weapons of the modern age. Some economists now say that inflation has become a psychological game. The moment people start believing prices will rise, they stockpile more goods, demand higher wages, and businesses raise prices in advance out of fear that costs will increase. In this sense, inflation is sometimes created directly by people's expectations, a kind of self-fulfilling prophecy. So what is the solution? In the digital age, central banks now try to manage inflation not only through interest rate decisions, but also through communication strategies. Because a single word, a signal, or a statement can shift market direction. At the same time, artificial intelligence, data analytics, and algorithms are beginning to surpass human capabilities in predicting inflation. Systems that can analyze billions of data points within seconds and forecast price movements may soon become the invisible guides of economies. Yet despite all this technological power, one fundamental truth remains unchanged. Inflation is still a human-made phenomenon. Those who trigger it, control it, and interpret it are all guided by the human mind. And behind every economic storm lies a decision made, a solution delayed, a mistake overlooked, or a reaction driven by fear. In the final analysis, we cannot avoid asking this question: is inflation truly a game played by external forces, or a reflection of humanity's own mistakes? Perhaps it is both, because inflation is not only an economic indicator, but also a reflection of human psychology, political choices, and the global order. In the end, there is only one thing that should remain in mind. Understanding inflation is not just about understanding prices. It is about understanding the invisible dynamics that shape the world, human behavior, and the sense of trust beating at the heart of the economy. Now the floor is yours. Among all the actors that fuel inflation, which one do you think is the real driving force? Share your thoughts in the comments, because this discussion may be the first step toward the ideas that will shape the economy of the future.